In this session, we primarily focus on the relationship between stock prices and corporate profits. Now, we focus on this relationship between stock prices and corporate profits because of the impact of growth, inflation, and interest rates on corporate profits. As we can see from a typical income statement of a firm, that the broad macroeconomic indicators such as growth, inflation, and interest rates will affect the corporate profits of a firm and therefore its price. We also need to understand when we refer to corporate earnings or corporate profits that we actually refer to the future expectations of profits and not past declared profits. Since there is a theory called the efficient market hypothesis that states that stock prices reflect all publicly known information. Hence, for any movement in prices to occur, there needs to be some unknown or new information made available to the market to cause a reaction. So generally, when firms issue profit warnings or when their earnings deviate from market expectations, that is when we see a reaction in prices. By the end of this session, you should have a good grasp on the relationship between corporate earnings and stock prices and the influence of economic growth, inflation, and interest rates on corporate earnings. Simply put, stocks, also called shares or equity, represent ownership in a company, and the owner is called a shareholder. Stocks are theoretically priced using a dividend discount model, which is simply the present value of cash flows, just as we saw with bonds, except that the cash flows here are corporate dividends. Now, stocks can also be priced using the capital asset pricing model, in short, the CAPM. We really don't need to study these pricing models as it's not relevant. What we really need to understand here is that stock prices are directly related to expected corporate profits. The higher the expected earnings, the higher the potential dividend payout, and higher the capital gains expectations. Investors investing in stocks look for either a return in the form of a dividend payout or a capital appreciation or both. So there is sufficient empirical evidence of stock prices being correlated to corporate earnings, and therefore we can safely infer that if corporate earnings rise, then stock prices will rise, barring unusual events such as political upheavals, war, etc. And if corporate earnings fall, then so do prices. Now, let's move on to what macroeconomic factors cause corporate earnings to fall or rise. But before we do that, we need to be aware that there are firm-specific or microeconomic factors that boost earnings, such as productivity, cost control measures, technological advancements, etc., that a firm can improve to counter the factors that adversely affect corporate earnings. Let's first look at economic growth. During periods of low economic activity, corporate earnings are depressed, and during high economic activity, corporate earnings rise. We will see why this is so in the later chapters, but in a nutshell, during high economic activity, consumer spending increases on goods and services due to higher incomes. This increase in the demand for goods and services puts pressure on production. Firms produce more to meet this demand, generating higher profits, and higher profits translate to higher stock prices. The reverse occurs during a slowdown. Firms produce less of goods and services due to a fall in consumer demand, which in turn is due to a reduction in spending.